Hello everyone, myself Shashank, currently pursuing MBA in Sri Venkateswara College of Engineering, which is affiliated to VTU. Today I am going to present a PPT on need of capital budgeting. Cap- Capital budgeting is an essential tool for business growth where the companies use to evaluate and prioritize the potential investments or expenditures. The goal is to determine which projects are worth pursuing and allocate financial resources accordingly. Capital budgeting is an important because these decisions can significantly impact on companies' future growth and profitability, and it is a crucial aspect of financial decision making. It involves planning and evaluating investments in long-term assets, ultimately driving business growth and profitability. Importance of capital budgeting: strategic alignment, resource allocation, financial sustainability, competitive advantage. Strategic alignment: capital budgeting ensures that investment decisions align with overall business strategies, contributing a long-term goals and objectives. Resource allocation: it helps organizations prioritize and allocate resources effectively, maximizing the returns on investments and minimizing financial risk. Financial sustainability: capital budgeting promotes financial stability by ensuring that investments are viable and contribute to companies' overall financial health. Competitive advantage: strategic investments in capital assets, competitive edge by enhancing product and market position. Capital budgeting process: project identification, proposal development, evaluation and selection, implementation and monitoring. Project identification: identifying potential projects that align with the business strategy and have the potential to generate a value. Proposal development: developing detailed proposals for each project, including cost estimates, revenue projections, and risk assessments. Evaluation and selection: analyzing the and evaluating projects using various techniques to determine their financial viability and prioritize investments. Implementation and monitoring: implementing approved projects, closely monitoring their progress and making adjustments as needed. Evaluation techniques: discounted cash flows methods, non-discounted cash flow methods, sensitivity analysis. NPV and IRR are commonly used techniques that consider the time value of money, discounting future cash flows to present a value. Non-discount cash flow method, payback period and profitability index are a simpler method that focus on the time to take initial investments and ratio of present value of future cash flows to initial investments. Sensitivity analysis, technique used to assess the impact of a change in key assumptions on a project profitability, providing insights in potential risk and uncertainties. Net Net present value is a difference between the present value of a future cash inflows and the initial investment. A positive NPV indicates that the project is expected to generate a return greater than the required rate of return, making it a desirable investments. NPV is also used in capital budgeting and investment planning to analyze the project's profitability. Internal rate of return is a method of calculating an investment's rate of return. The term internal refers to the fact that calculation excludes external factors such as risk-free rate, inflation, the cost of capital, or a financial risk. IRR is the discount rate that makes NPV of a project equal to zero. It represents the project's expected rate of return. A project is considered acceptable if the IRR exceeds the required rate of return. Payback period. Payback period is the time it takes for a project's cumulative cash inflows to equal initial investments. It provides a quick measure of liquidity, indicating how long it takes to record the investments. Profitability index is a ratio that measures the attractiveness of a project or investments. It's calculated by dividing the present value of future expected cash flow by indicating initial investments amount. The PI can also be calculated by dividing the net present value plus initial investments. PI is greater than the suggests that project is profitable and should be considered. Sensitivity analysis is a study of how the uncertainty in output of a mathematical model or a system can be divided and allocated to different sources of uncertainty in inputs. Capital budgeting is an essential for a business to evaluate and plan for a long-term investment such as purchasing a new equipment, expanding their businesses or projects where such as resource allocation helps in allocating limited resources to most profitable ventures. Risk management assesses potential risk associated with investments, allowing businesses to avoid minimize the losses. Long-term planning encourages and focus on sustainable growth by evaluating projects that yield returns over several years. Cash flow assessment analyzes the future cash flows and outflows, helping to maintain liquidity. Strategic decisions making and aids in aligning investment decision with the company's long-term strategic goals. And capital budgeting is an essential process for informed investments decisions. It's crucial to utilize the most appropriate evaluation techniques and consider the various factors such as risk and uncertainty before making investment commitments.